Hello, all. Welcome to the topic Business Valuation. In this presentation, we are going to cover the following topics: overview of business valuation, approaches to business valuation, other methods of valuation, checkpoints in valuation, and we'll see various case studies. First, let's look at an overview of business valuation. Business valuation is a process and a set of procedures used to estimate the economic value of an owner's interest in a business. The value of a business depends not just based on its past performance, but also based on its ability to create value in the future. There are various factors to be considered, which includes economic conditions, industry, sector, and the valuation method. Now, what is the difference between value, cost, and price? Value refers to the worth of a thing, whereas cost is defined as the resources sacrificed to produce or obtain a thing. Price is what is charged by a seller or provider of a product or service, and it is often a function of market forces. For example, you have incurred rupees 1000 for making a special product which is highly beneficial to the agricultural sector. You quoted 1200 rupees for the product. Here, 1000 rupees is the cost and 1200 rupees is the price, while the benefits obtained by the customer is the value of the product. Every valuation has a story or a narration behind it, and hence valuation is beyond numbers. However, care needs to be taken as valuation can go wrong due to bias, uncertainty, and complexity. There are multiple reasons for business valuation: to understand the value or worth of a business, for exit strategy planning, to evaluate an offer and negotiate a strategic sale of a business, to determine the annual per share value of an employee stock ownership plan or ESOP, to justify the per share equity value in a company. For shareholder or partnership disputes, for buy sell purposes, to obtain bank financing or alternative investment, to identify whether the business is growing, stagnant, or declining in value, to restructure the business, for litigation support purposes, for financial reporting purposes, to identify weaknesses in a business, to refocus the operational efforts to improve profitability and the bottom line. Some facts to be kept in mind. Price is not the same as value. Valuation is subjective and it differs from person to person, place, or time. Valuation is done at a specific point of time. Though valuation helps to determine the transaction price to an extent, actual transaction takes place at negotiated prices after discussions between buyer and seller. Next, we'll discuss the various valuation terminologies used. DD or due diligence. This is a process by which the investor will examine every aspects of your business, including assets, liabilities, revenue, compliances, etc. This is usually done by the buyer or investor before finalizing a transaction to identify if there is any potential risk in the company. Burn rate. This is the value of cash a company loses per month. Exit strategy. This is a strategy by which a business owner can reduce or liquidate his stake in a business. An example could be a potential takeover by another company. Cap table. Table providing an analysis of percentage of ownership and value of equity in each round for promoters and investors. Convertible note. Debt that will be converted into equity. Liquidation preference. This is to determine who gets paid first and how much when there is a liquidation event. Free cash flow to firm or FCFF. This is the cash available to pay investors including bondholders and stockholders, after meeting all costs of doing business, investments in short term assets like inventory, and investments in long term assets like property, plant, and equipment. Free cash flow to equity or FCFE. This represents the cash available for distribution to shareholders. Beta. Beta is a numeric value that measures the fluctuations of a stock to changes in the overall stock market. DLOM or discount for lack of marketability. It is a discount applied for non-marketability, low transferability and liquidity of shares. DLOC or discount for lack of control is a fixed amount or percentage deducted from the selling price of a block of shares. The amount is deducted from the share value because that block of shares lacks some or all powers of control in the firm. A pre-money valuation of a company refers to the company's agreed upon worth before it receives the next round of financing, while the post-money valuation of a company refers to its value immediately after receiving the capital. Let's look at an example. In the given example, your post-money valuation is rupees 1 crore divided by 33%, that is rupees 3 crore. When you deduct the investment of rupees 1 crore from the post-money valuation, you arrive at your pre-money valuation of rupees 2 crore. Now, how do we calculate value of a share and share premium? After diluting 33% shares to investor, the pre-investment number of equity shares will be equivalent to 67%. Thus, post-investment, number of shares will be 1000 by 67%, which is equal to 1493. That is, 493 shares are to be issued to the investor against rupees 1 crore. So, issue price per share will be 1 crore divided by 493, which is equal to rupees 2284. Premium per share will be the difference between issue price and face value, that is rupees 20,184. Next, let's have a look at various approaches to business valuation. There are three internationally accepted methods of valuation. 1. Asset based, 2. Income based, and 3. Market based. Under asset-based approach, there are various methods like book value method, replacement method, and liquidation value method. Under income-based approach, the most common methods are capitalization method and cash flow-based method. Under market-based approach comes comparable companies multiple method, comparable transaction multiple method, and market value method. Book value method represents the net asset value of the company, which is basically assets minus liabilities. On dividing the net assets by number of shares, we get net asset value per share. Replacement value represents the cost to replace the assets or resources to set up an identical business with similar revenue potential. Liquidation value represents a value that will be left for the shareholders after liquidating all the assets and liabilities. The first method which we discussed under income approach is capitalization method. The capitalization method basically divides the expected earnings of the business by the capitalization rate. This is calculated by net operating income divided by capitalization rate, where capitalization rate equal to discount rate minus growth rate. The second method which we discussed under income approach is DCF or discounted cash flow method, which is most commonly used. In this, the value of the company represents the present value of the future cash flows that it is expected to generate. Steps to build financial projections for DCF. First, a historical financial and industry analysis will be performed. and key revenue and cost drivers will be identified. Data request will be passed on to the management, and thereafter a review and discussion on management assumptions will be conducted. Have a detailed breakup. For example, how much customers you will get, what will be your average revenue per unit, what are your staffing requirements, marketing strategy, etc. Financial projections will be prepared for a specified forecast period, an example of 5 years. This should be confirmed by the management before commencing valuation exercise. In addition, check if the margins are achievable and reasonable in the industry and have basis for all your calculations. The future cash flows thus identified is to be converted into the present value by discounting the values using appropriate discount rate. The discount rate is normally WACC, weighted average cost of capital, in case of FCFF. In case of FCFE, cost of equity is considered as discount rate. Next, terminal value needs to be calculated. Terminal value determines a company's value into perpetuity beyond a set forecast period and is added with future cash flows. There are various methods to compute cost of equity. As per CAPM, cost of equity equal to risk-free rate of return plus beta into market risk premium, where market risk premium is equal to expected return minus risk-free rate of return. Now let's look at an example. Assumptions of ABC Private Limited. Long-term growth of revenues and after-tax operating income is 3% annually. The gross profit margin will remain at 40%. Depreciation will remain at 1.8% of sales. SG&A expenses can be maintained at the prior year's level of INR 37 lakhs at least for 2 years. Working capital equal to 10% of revenues is required. Capital expenditures are expected to equal projected depreciation expense to support current operations plus 5% of incremental revenues to support future growth. In this calculation, first operating income after tax is arrived. To that, non-cash expenses such as depreciation is added back, non-operating activities such as interest is added back, capital expenditures are deducted, changes in working capital are adjusted, and free cash flow to firm can be arrived. In this step, terminal value is calculated, values are discounted, and indicative enterprise value is arrived. To arrive at free cash flow to equity, net borrowing repaid and interest are reduced from FCFF. To FCFE, if terminal value is added and the values are discounted, indicative equity value can be arrived. Here is another sample for arriving at value per share using DCF. To the enterprise value arrived as per DCF working, reduce debt as on valuation date and contingent liabilities likely to crystallize. Add surplus assets and you will arrive at the business value as at valuation date. On deducting the fair value of preference shares as at valuation date, you arrive at the business value for equity shareholders. Equity value per share is arrived by dividing business value for equity shareholders by the number of equity shares and reducing discount for lack of marketability. Now, what are surplus assets or non-operating assets? These are assets that are not essential for the operation of the business by a company. Examples include excess cash and bank balance of the company, vacant land not proposed to be used for operations. Now let's look at various methods under market approach. 1. Comparable company multiple method. This method uses the valuation multiples of similar or comparable publicly traded companies to value a company. Examples include EV by revenue, EV by EBITDA, etc. It is often difficult to define the right comparable private companies. Hence, necessary adjustments should be made while arriving at the value. While doing any valuation, earnings have to be normalized by adjusting non-recurring, non-economic and unusual items. There are various ways to arrive at comparable companies. One method is to select listed companies in the same industry, apply a revenue filter to arrive at companies with similar size of operations, and check the business profile and the annual reports to arrive at the final list of comparable companies. Another method under market approach is comparable transactions multiple method. The analysis uses multiples and premiums paid in comparable transactions to value target companies. The ideal comparable transactions should have the following characteristics. Industry group should be similar. It should be a recent transaction. Business mix, geographic location, and size should be comparable. Another method under market approach is comparable transactions multiple method. The analysis uses multiples and premiums paid in comparable transactions to value target companies. The ideal comparable transactions should have the following characteristics. Industry group should be similar. It should be a recent transaction. Business mix, geographic location, and size should be comparable. The steps involved in this method are: 1. Collect information on recent transactions of comparable companies. 2. Calculate multiples for comparable companies. And 3. Estimate business value based on multiples. Market value method also comes under market approach, and this is used for quoted securities. This method evaluates a value on the basis of prices quoted on the stock exchange. Various other methods of valuation like rule of thumb, Berkus method, risk factor summation method, scorecard method, etc. There are some points to be considered while doing any valuation. Non-recurring items, extraordinary items or other income, impact of seasonal events, intangible asset valuation, corporate governance and transparency, discounts and premiums, non-operating assets or excess cash, off-balance sheet items, consistency in accounting practices, operational environment, legal and tax. Hope you had an informative session. Thank you.